Welcome to Wealth Investment Academy. We're thrilled to have you here on a journey to unlock the exciting world of stock market investing. Whether you're starting from scratch or looking to refine your knowledge, this comprehensive guide is your key to becoming a confident investor. At Wealth Investment Academy, we believe everyone deserves the opportunity to grow their wealth and achieve financial freedom. We provide clear, actionable insights to empower you in the stock market. Our mission is to demystify investing, making it accessible and understandable for everyone. We understand that taking the first step into the world of investing can feel daunting. That's why we've created this ultimate beginner's guide, breaking down complex concepts into easy-to-digest pieces. Let's embark on this journey together and unlock your full potential as an investor. Imagine a future where you're in control of your finances, where your money works hard for you, and financial worries become a thing of the past. That's the power of investing, and it's all within your reach. This guide will equip you with the knowledge and tools to make informed decisions, build a solid portfolio, and navigate the stock market with confidence. We'll cover everything from the fundamentals of how the market works to choosing the right investment strategies for your goals. No matter your background or experience level, this guide will empower you to take charge of your financial well-being. We'll demystify jargon, break down barriers, and guide you step by step towards your investment goals. Every successful investor starts somewhere. This guide is your roadmap to navigating the stock market with confidence and clarity. We'll provide you with a solid foundation, empowering you to make informed decisions every step of the way. We'll delve into the core concepts of stocks, bonds, diversification, and risk management. You'll learn how to identify promising investment opportunities, analyze company performance, and build a portfolio aligned with your unique goals and risk tolerance. Remember, investing is a marathon, not a sprint. We'll emphasize the importance of a long-term perspective, patience, and staying focused on your financial objectives. By the end of this guide, you'll have the knowledge and confidence to transition from a novice investor to a knowledgeable market participant. We'll provide you with actionable steps and practical advice to put your newfound knowledge into practice. We'll explore a range of investment strategies, from dollar-cost averaging to value investing, empowering you to choose approaches that align with your risk appetite and financial goals. You'll learn how to avoid common investing pitfalls and make smart decisions that benefit your financial future. This guide is your gateway to a world of financial empowerment. Let's embark on this exciting journey together and unlock the incredible potential of stock market investing. Imagine a bustling marketplace, but instead of fruits and vegetables, people are buying and selling pieces of companies. This is the stock market, a vast network where buyers and sellers trade ownership in companies. Think of it like a giant auction house where prices fluctuate based on supply and demand. When more people want to buy, prices go up. When more people want to sell, prices go down. At the heart of the stock market are stocks, also known as shares or equities. These represent fractional ownership in a publicly traded company. By purchasing a share of stock, you become a shareholder, owning a small piece of that company. Your ownership stake is proportional to the number of shares you hold compared to the total number of outstanding shares. For example, if a company has issued 1 million shares and you buy 100 shares, you own 0.01% of that company. Owning stock gives you certain rights, including the potential to earn dividends, which are a portion of the company's profits, and vote on important company matters. However, it's important to remember that stock ownership also comes with risks. The value of your shares can fluctuate, and you could potentially lose money if the company's performance deteriorates or market conditions turn unfavorable. Before a company can offer shares to the public on the stock market, it must go through a process called an initial public offering, or IPO. This involves registering with the Securities and Exchange Commission and offering shares to institutional and individual investors. Going public allows companies to raise capital for expansion, research and development, or other strategic initiatives. It also provides early investors and employees with an opportunity to liquidate some or all of their holdings. Once a company goes public, its shares are traded on a stock exchange, where buyers and sellers can connect and execute trades. The price of the stock is then determined by the forces of supply and demand in the open market. In the United States, the two most prominent stock exchanges are the New York Stock Exchange, or NYSE, and the Nasdaq stock market. The NYSE, located on Wall Street in New York City, is the world's largest stock exchange by market capitalization, representing the total value of all listed companies. The Nasdaq, on the other hand, is an electronic exchange that operates through a network of computers and dealers. It's known for listing many technology companies and for its focus on innovation and growth. To track the overall performance of the stock market or specific sectors, investors often refer to market indices. These indices, like the Dow Jones Industrial Average, or DJIA, the S&P 500, and the Nasdaq Composite, represent a basket of stocks selected to reflect the broader market or specific segments. The DJIA, for instance, tracks the performance of 30 large publicly owned companies based in the United States, while the S&P 500 includes 500 large cap companies across various sectors. These indices provide a snapshot of market sentiment and can be used to gauge investor confidence and economic health. By understanding how these indices are calculated and what they represent, investors can gain valuable insights into market trends and make more informed investment decisions. Before diving headfirst into the world of investing, it's crucial to establish a clear understanding of your financial goals. Just as a ship needs a compass to navigate the vast ocean, you need a financial North Star to guide your investment journey. What are you saving for? Is it a down payment on your dream home, a comfortable retirement nest egg, your child's education, or perhaps a combination of these aspirations? Defining your financial goals provides the motivation and direction you need to stay focused on your investment journey. Remember, investing is not a one-size-fits-all endeavor. Your goals will shape your investment strategy, influencing the types of investments you choose, the level of risk you're comfortable with, and the time horizon for your investments. Investing with a purpose transforms a daunting task into an exciting pursuit. When you have a clear vision of what you're working towards, every dollar invested becomes a step closer to achieving your dreams. For instance, if you're saving for retirement decades from now, you might consider a more aggressive investment approach, focusing on growth-oriented stocks with higher potential returns. On the other hand, if you're saving for a down payment on a house in a few years, a more conservative approach with lower risk investments might be more suitable. By aligning your investment strategy with your financial goals, you can make informed decisions that maximize your chances of success. Remember, investing is not about getting rich quick. It's about building a secure and prosperous future. Just as every individual has unique financial goals, each investor also possesses a distinct risk appetite, the level of uncertainty they are comfortable with when it comes to their investments. Some investors are comfortable with higher risk investments that offer the potential for higher returns, while others prefer a more conservative approach, prioritizing the preservation of capital over rapid growth. There's no right or wrong answer when it comes to risk tolerance. It's a personal decision influenced by factors such as your age, financial situation, investment timeline, and overall comfort level with market fluctuations. It's essential to assess your risk tolerance honestly before making any investment decisions. If you're unsure about your risk appetite, consider seeking guidance from a qualified financial advisor who can help you determine a suitable investment approach. In investing, there's an enduring relationship between risk and return. Higher potential returns are typically associated with higher risk. Significant growth means larger fluctuations in investment value. Prioritizing capital preservation often means more modest returns. Find the right balance between risk and return that aligns with your financial goals. Imagine putting all your eggs in one basket. If that basket were to fall, you'd lose everything. In investing, putting all your money into a single stock or asset class is akin to using that fragile basket. This is where diversification comes in, the bedrock of a resilient investment strategy. Diversification involves spreading your investments across different asset classes, industries, and geographical regions. This strategic allocation helps mitigate risk by ensuring that the poor performance of one investment won't cripple your entire portfolio. Think of it like building a sturdy house. Instead of using just one type of material, you'd use a combination of wood, concrete, metal, and glass, each contributing to the structure's overall strength and stability. Similarly, a diversified portfolio combines various assets to withstand market fluctuations and deliver more consistent returns over time. Asset allocation is the cornerstone of diversification. It involves dividing your investment capital among different asset classes based on your financial goals, risk tolerance, and investment timeline. The most common asset classes are stocks, bonds, and cash equivalents. Stocks, representing ownership in publicly traded companies, offer the potential for high growth, but also come with higher volatility. Bonds, essentially loans to governments or corporations, provide more stability and income, but may offer lower returns. Cash equivalents, such as savings accounts and money market funds, offer liquidity and capital preservation, but typically yield lower returns. The ideal asset allocation varies from investor to investor. A younger investor with a longer time horizon might choose a more aggressive allocation with a higher proportion of stocks, while an older investor nearing retirement might opt for a more conservative approach with a larger bond allocation. As we've discussed, stocks represent ownership in publicly traded companies. When you buy a stock, you're essentially buying a small piece of that company and participating in its future success or failure. Stocks offer the potential for significant growth over the long term, making them an attractive option for investors seeking capital appreciation. However, it's crucial to remember that stocks are also the most volatile asset class. Their prices can fluctuate significantly in the short term, influenced by factors like company performance, economic conditions, and investor sentiment. This volatility underscores the importance of diversification within your stock holdings. Rather than concentrating your investments in a single stock or sector, consider diversifying across different industries, company sizes, large cap, mid cap, small cap, and geographical regions. This approach helps mitigate risk by reducing your exposure to the ups and downs of any single company or sector. Bonds offer a different risk-return profile than stocks. When you buy a bond, you're essentially lending money to a government entity or a corporation. The borrower promises to repay the principal amount, which is the amount you invested, at a specified maturity date and to make periodic interest payments, known as coupons, along the way. Bonds are generally considered less risky than stocks. Their prices tend to fluctuate less, and they provide a steady stream of income through coupon payments. This makes them an attractive option for investors seeking stability and income, particularly those nearing retirement or with a lower risk tolerance. However, bonds are not without risk. Inflation can erode the purchasing power of future interest payments and principal repayments. Interest rate changes can also impact bond prices. When interest rates rise, the prices of existing bonds tend to fall, and vice versa. Section 5. ETFs. Baskets of opportunities. Exchange-traded funds, or ETFs, have gained immense popularity in recent years, offering investors a convenient and cost-effective way to achieve instant diversification. An ETF is a type of investment fund that holds a basket of assets, such as stocks, bonds, or commodities, and trades on stock exchanges like individual stocks. ETFs offer several advantages. They provide instant diversification by investing in a variety of assets with a single purchase. They are highly liquid, meaning you can buy and sell them easily throughout the trading day. They typically have lower expense ratios compared to actively managed mutual funds. There's a wide range of ETFs available, tracking various market indices, sectors, and investment themes. For example, you can find ETFs that track the S&P 500, the NASDAQ 100 emerging markets, or specific sectors like technology, healthcare, or renewable energy. Dollar cost averaging, or DCA, is a straightforward investment strategy that helps mitigate market volatility. The essence of DCA is to invest a fixed amount of money at regular intervals, regardless of market conditions. By doing so, you buy more shares when prices are low and fewer shares when prices are high, lowering the average cost over time. For instance, investing $200 every month in a stock means buying fewer shares when prices are high and more when prices are low. This method reduces the risk of investing a large sum at an inopportune time and smooths out short-term market fluctuations. DCA requires discipline rather than market timing, making it an excellent strategy for beginner investors. The buy and hold strategy involves purchasing investments and holding them for an extended period, regardless of market fluctuations. This strategy is based on the belief that the stock market tends to rise over time, rewarding long-term investors with substantial returns. It involves identifying quality investments with strong fundamentals and holding them through market ups and downs. One significant advantage is minimizing transaction costs and capital gains taxes, which can erode returns. By holding investments long-term, you avoid these costs and benefit from compounding. This strategy helps investors avoid the pitfalls of market timing and stay focused on the bigger picture. Growth and value investing are two prominent strategies catering to different types of investors. Growth investing focuses on companies expected to grow at an above-average rate, often reinvesting earnings to fuel expansion. Growth investors seek companies with strong revenue and earnings growth, competitive advantages, and market disruption potential. While growth stocks can offer substantial returns, they also come with higher risk due to volatile valuations. Value investing involves finding undervalued stocks trading below their intrinsic value. Value investors look for companies with strong fundamentals temporarily out of favor, offering a margin of safety. These stocks may have lower price-to-earnings ratios, higher dividend yields, and stable cash flows. Understanding the distinctions between growth and value investing helps align your strategy with your risk tolerance and goals. Some investors combine both approaches for a diversified portfolio. While having a defined investment strategy is essential, it's important to recognize that market conditions change over time. Adapting your strategy to different market environments can enhance your investment outcomes. During bull markets, growth strategies often outperform, while value investing may provide more stability during bear markets. Consider economic cycles and sector rotations, as different sectors perform better at various stages. Adapting your strategy means periodically reassessing your portfolio to ensure it aligns with current market conditions and your financial goals. Staying informed about economic trends and market sentiment can guide these adjustments. A crucial element of successful investing is maintaining a long-term mindset. Investing is not a get-rich-quick scheme, but a journey requiring patience, discipline, and a focus on long-term goals. The stock market can be volatile in the short term, but historical data shows it delivers positive returns over the long term. By adopting a long-term mindset, you can ride out short-term volatility and benefit from compounding growth. Compounding occurs when returns generate their own returns, leading to exponential growth over time. Staying focused on long-term goals helps avoid reactive decision-making based on short-term market movements. Emotional reactions, like panic selling during downturns, can lead to significant losses. By keeping your eyes on long-term objectives, you can make more rational decisions. Remember, investing is a marathon, not a sprint, and maintaining a long-term perspective is key to financial success. Fundamental analysis is the art of examining a company's financial health to determine its intrinsic value and growth potential. Just as you wouldn't buy a bruised apple, you wouldn't invest in a company with shaky financials. Fundamental analysis provides a framework for making informed investment decisions, moving beyond market sentiment and speculation. It helps separate promising opportunities from potential pitfalls, guiding you toward companies with solid foundations. By delving into financial statements, industry trends, and competitive landscapes, you gain valuable insights for confident investment decisions. Successful investing is about understanding the underlying value of the businesses you're investing in. Financial statements are the language of business, providing a snapshot of a company's financial performance and health. Key financial metrics to focus on include earnings per share, EPS, measures profitability on a per-share basis. Price to earnings, PE ratio, compares stock price to earnings per share, indicating valuation. Debt to equity, DE ratio, measures financial leverage, indicating the proportion of debt to shareholder equity. Return on equity, ROE, measures profitability relative to shareholder equity. These metrics provide insights into a company's financial performance and health. Comparing these metrics to industry averages and historical trends helps understand a company's strengths and weaknesses. While financial metrics are essential, qualitative factors also play a crucial role in determining long-term success. A strong management team is crucial for guiding a company towards sustainable growth. Understanding a company's competitive environment is essential for assessing long-term prospects. Industries evolve, influenced by technological advancements, consumer preferences, and regulatory changes. These qualitative factors provide valuable context for interpreting financial metrics and assessing long-term sustainability. Investing is about understanding the businesses behind the numbers. In today's digital age, a wealth of information is available, making it easier to research companies and investment opportunities. However, this abundance can be overwhelming, making it challenging to separate credible sources from noise. Seek reputable financial websites like Yahoo Finance, Google Finance, and Bloomberg. Investor relations pages provide access to financial statements, annual reports, and presentations. Research firms like IBISWorld and Statista offer insights into market size, growth trends, and competitive landscape. Thorough research is the foundation of informed investment decisions. Choosing the right stocks is about selecting investments that align with your overall strategy, risk tolerance, and financial goals. Focus on companies with strong revenue growth and innovative products. Seek undervalued companies with strong fundamentals and low debt levels. Prioritize companies with a history of paying consistent and growing dividends. Diversification remains crucial even within a specific investment style. Spreading investments across different sectors and industries mitigates risk and enhances potential returns. The stock market is a realm of constant fluctuation, where euphoria and panic can sweep through investor sentiment unpredictably. It's easy to get caught up in the emotional roller coaster of market swings, but succumbing to these impulses can be detrimental. Fear and greed are powerful motivators, often leading to impulsive buying or selling at the worst times. Successful investing is about making rational decisions based on sound analysis and a long-term perspective. Just as a seasoned captain navigates a ship through stormy seas, a disciplined investor stays the course. Weathering market fluctuations with a calm and steady hand is key to long-term success. Imagine setting sail on a journey without a map, compass, or any knowledge of navigation. In investing, diving into the market without thorough research is akin to embarking on that ill-fated voyage. One of the biggest mistakes novice investors make is failing to do their homework. Investing without research is like gambling, betting on chance rather than making informed decisions. Before investing, understand the company's business model, financial health, competitive landscape, and growth prospects. Thorough research is the foundation of informed investment decisions. The allure of timing the market, buying low and selling high, is a siren song that has lured many investors to financial ruin. Consistently timing the market is an exceptionally difficult, if not impossible, feat. The stock market is influenced by unpredictable factors like economic data, geopolitical events, and investor sentiment. Rather than trying to time the market, focus on time in the market. History shows that, over the long term, the stock market tends to rise. By investing consistently and staying invested, you benefit from compounding and increase your chances of achieving financial goals. Section 4. Staying focused. The long game. In a world of instant gratification, it's easy to lose sight of the long-term perspective required for successful investing. Headlines about market crashes and economic uncertainty create urgency and anxiety. Investors often abandon their long-term strategy when the market becomes volatile. Panic selling locks in losses just when the market is poised for a rebound. Investing is a journey requiring patience, discipline, and commitment to financial goals. A disciplined, long-term mindset helps navigate market complexities and achieve financial success. Section 1. Navigating the digital toolkit. In today's digital age, investors have an abundance of tools and resources at their fingertips. These tools range from comprehensive financial websites to sophisticated investment platforms. Reliable financial websites or apps are invaluable. They provide real-time stock quotes, historical charts, and financial news. Popular options include Yahoo Finance, Google Finance, and Bloomberg. Many sites offer advanced tools like stock screeners and portfolio trackers. Stock screeners help filter stocks based on criteria like market cap or PE ratio. Portfolio trackers provide a consolidated view of your investments. Earnings calendars alert you to upcoming earnings releases. Choosing the right investment platform is crucial for executing trades and managing your portfolio. Online brokerages like Robinhood, Stash, and Acorns cater to beginners with user-friendly interfaces and low fees. These platforms simplify investing, making it easy to buy and sell stocks with just a few taps. Full-service brokerages like Fidelity, Schwab, and Vanguard offer more options and personalized advice for experienced investors. Consider trading fees, account minimums, and research tools when choosing a platform. The world of investing is constantly evolving, with new trends and strategies emerging regularly. Continuous learning is essential for making informed investment decisions. A wealth of educational resources is available, from free online courses to in-depth books. Khan Academy offers comprehensive free courses on finance and investing. Classics like The Intelligent Investor by Benjamin Graham provide timeless wisdom. Staying informed about market trends, economic data, and geopolitical events is crucial for making informed investment decisions. Financial news websites, investment blogs, and social media platforms provide constant information. Focus on credible sources. Reputable sites like the Wall Street Journal, Bloomberg, and Reuters offer comprehensive market coverage. These sources provide valuable insights into market trends and investment opportunities. Utilize a combination of these resources to stay informed and make confident investment decisions. Congratulations on completing this beginner's guide to stock market investing. You've equipped yourself with tools and insights to navigate investing. Look at you now, understanding market dynamics and investment strategies. Embrace the realization that you're in control of your financial future. The stock market is now a landscape you can navigate with confidence. The journey ahead may have its share of twists and turns, but armed with a sound investment strategy, a commitment to continuous learning, and the power of a long-term perspective, you're well equipped to navigate the complexities of the stock market. Remember, even the most successful investors started somewhere. Wealth Investment Academy is here to support you every step of the way, providing valuable insights, educational resources, and a community of like-minded individuals. Thank you for joining us on this journey of financial empowerment. Don't forget to subscribe to our channel for more in-depth investing content. Happy investing!